You're watching Stock Watch this week. I'm Ntauleng Lechela, and joining me to unpack your stock-related questions today, Chantal Marx from FNB Wealth and Investments and Roy Mutooni from Sanlam Investments. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392, or on X at Business Day TV using the hashtag Stockwatch. Chantal, Roy, thanks so much for joining me this afternoon. Now, it's really been, it's really President Trump's world, and we just live in it, to be quite honest. I mean, you put your head down for 10 minutes, next thing you know, there are tariffs here, there are tariffs there. Like, what do we make of all of these moves? I can imagine just being within the markets and watching markets. It's just very tough times because it's so volatile. Chantal, let's start off with you.
Yes, so you summarize it perfectly. Tariffs here, tariffs there, no longer tariffs anywhere. And that's exactly what it results in. It results in a volatility and it results in uncertainty. So what we make of it is we try to look at it exactly like we would any other uncertain or volatile event. You don't know what you don't know. That means it's very important to have some powder dry. So make sure that you have some cash available, because the opportunities will arise in the midst of this chaos. For now, it doesn't seem as if he will be president of the United States forever. So we have to start looking from a longer term investment perspective and take those opportunities as they come up.
And looking at things from a longer term investment, the gold price has, been hitting record highs over the past few weeks, and we've seen the gold players also benefiting from that. Roy, there is a question on gold miners, and it reads, may I get the panel's view on the following gold miners: Gold Fields, Harmony Gold, and Rio Tinto?
Okay, so maybe if I start with the gold price, because I think that's the underpin for all of this. So typically when yields go up, long-term yields go up, gold tends to follow real yields. But what we found more recently, it actually hasn't. And that's because of the volatility around Trump and all of these tariffs and the fact that we're not sure. So what we've seen is the gold price really rallying, getting up to just under that 3,000 level. And the question is, can it go beyond this? If it can, it's really positive for all of these stocks. If it can't, then maybe these stocks have just basically rallied too far. And that's the big question. What's the big underpin? Maybe there's a lot more central bank buying, there's a lot more investment market buying, and there's a whole lot of other conspiracy theories under there. So there is a bit of an underpin, but that 3,000 seems to be almost holding as a ceiling. So when it comes to these stocks, the thing about them is you add operational complexity onto the gold price when you buy a gold stock. So when you buy a rand-denominated gold stock such as Harmony, what you're looking for is leverage. So their costs are in rands, their revenue is in dollars. So the rand weakens and the dollar price rises, you do incredibly well. So that's what you're looking for in all of those. But then you get production complications, and that's what I think you're seeing in places like Harmony. Goldfields, not so much now. They seem to have cleaned up their act over the past few reporting periods. And sorry, which was the last one?
Rio Tinto.
Not sure that Rio Tinto is a gold mining company, but I think the sentiment around gold mining companies is exactly that.
Yeah.
So in good times, when yields are low and when the gold price is rising, you'd rather be you choose to either be in the gold commodity itself or into well-run gold companies for the leverage. In difficult times, you have to be very confident about what management is doing, about the quality of their production and their cost of production. I think that's broadly the way to think of it. Goldfields is probably on the bottom of the quality curve, starting to pick up. Harmony is rand denominated, and like I said, I'm not. Maybe Chantal can clarify. I'm not convinced Rio is a gold miner.
All right, Chantal, let's get your views on that, and also maybe add DRD Gold and Pan-African Resources to that mix.
Yes, so just confirming what Roy is saying as well, Rio Tinto, as far as I know, is completely over-indexed to iron ore. So I think that's where most of their production is. If there is some gold in there, it is relatively small. So that's not the way to necessarily get gold exposure. Yeah, I mean, just talking about the stocks that you just mentioned, DRD and Pan African, both of them are in the tailings retreatment space.
Yes.
Pan African also in the underground mining space, as well as some other projects that they have going on, both centered on South Africa, although Pan African recently entered the Australian gold mining market as well. Both of them are relatively low-cost producers. Pan African's all-in sustaining cost is actually coming in lower. And Pan African specifically forward sold a lot of its gold last year at a lower gold price because they wanted to fund additional growth projects. Those projects have now come online. The forward sales agreements are done. So I think we're going to see a really nice uplift in revenue and profitability and free cash flow coming through from Pan African. So that's probably my top pick in the gold mining space right now. DRD, I think, also did a very, very good job over the last year, even though all-in sustaining cost is slightly high for me from it, if we consider that it's mostly tailings retreatment. I think that it's done a fine job from an operational efficiency perspective. So yeah, my preference is probably Pan-African at the moment. I think Anglo Gold is also a high quality producer, but as Roy also mentioned, not nearly as highly leveraged because you don't have the rand cost base.
Yeah. Let's stick with the mining sector for a bit. There's a question here on asking on the panel's view on Glencore and African Rainbow Minerals and which one of the two has a greater outlook. Chantal, I'll just stick with you there.
Yes, so I mean, I would prefer Glencore because it has quite substantial exposure to future-facing minerals, right? So they have copper assets, they have iron ore assets, they have, I think, zinc and nickel as well, chrome. So all of these are future-facing assets where I see a really solid future going forward. They do have some thermal coal assets where we've seen pricing come under pressure and where the future is less certain. But, I mean, they were looking to perhaps unbundle that business earlier or late last year. They could relook at that going forward as well. But with policies changing around ESG, emanating from the US and President Trump, that could be put off. But still, the company does quite well. They also have a big marketing arm, which does help diversify their revenue stream and makes them a little bit more defensive. African Rainbow Minerals, nice big exposure to Harmony, which would have helped them, but big exposure to iron ore, where pricing has been under pressure, as well as PGMs, where pricing has been very, very poor. So we saw a trading statement from them earlier this week, just indicating that earnings was going to come under a lot of pressure. And yeah, I mean, I think it's a company that can do very, very well should we start seeing commodity prices turn. But for now, my preference would be for Glencore.
All right, Roy, I'll give you another question. We're moving over to some JSE heavyweights, Naspers, Prosus. They were making headlines this week after Prosus announced that it'll be acquiring Just Eats for about 79 billion rands. It'll be getting 2-for-1, Just Eats and Takeaway.com in that deal. The question asks, does the panel think that holding both Prosus and Naspers in a single portfolio is wise? And what is the panel's view on these two stocks for 2025? Hold, or are they better? Are they either or hold, or are they better opportunities on the JSE?
So quickly, when you think about these two stocks, the underlying asset is Tencent.
Yes.
That's the biggest stock. That's the biggest driver of earnings in both of them. So if you like Tencent, then it does make sense to go into either or both of them, depending on the discounts that emerge in the market. Tencent is part of that e-commerce world in China, probably underperformed for some time from a share price perspective, but has grown earnings quite strongly. The WeChat is completely dominant within that Chinese market. So it's a fantastic business and continues to innovate. So that's the underpin of value there. Then the difference between Prosus and Naspers is if you're a foreign investor, you probably will look at Prosus, which is listed in the Netherlands, just because of access. Then if you're a domestic investor, you'd probably look at Naspers. Then there's the whole thing about discounts in between them and everything. But that's great detail. Your most important thing is you go into that detail if you like Tencent. And if you see value in Tencent, your main motivation is to say that you're holding Tencent at a deep discount in either of the two. There are other small investments and things like in Prosus. There's these acquisitions that have been made, but the primary investment case starts from Tencent. If you don't like Tencent, you don't look at these. You don't look at either of these stocks. I think looking forward, there's still a bit of a discount of the valuation of Tencent within the portfolio over the next, currently.
Yeah.
So there's probably some upside. Our analyst feels Tencent is probably close to being fully valued. There's still some upside, but it's close to being fully valued. So maybe as a combined whole, you don't have significant upside to come, and you will not earn market returns over the short to medium term. But I think over the long term, I think Chinese e-commerce or Chinese internet stocks right now are probably trading at such a deep discount to the US ones, it would be folly to ignore them at current valuations.
And Chantal, just your views on that. I mean, Tencent performing quite well within the Chinese economy that has been slowing for quite some time.
Yes, and some exciting developments and innovations within that WeChat app as well. They've incorporated DeepSeek into that, and so far the response has been quite positive. And of course, it's also in its own right a conglomerate with a host of internet-based services. I really like the stock. It's done quite well so far this year, but I think that it has more legs because once we start seeing a more positive turn towards China, which we're starting to kind of see anecdotally, you will probably start seeing earnings upgrades come through, and that will make the valuation for Tencent seem a lot more compelling. I like the fact that Prosus is trying to sweat their assets a little bit. I like the fact that there's some movement from a corporate actions perspective, that they're deploying the cash pile that they have available to them. Food delivery has really surprised me because I couldn't 5 years ago, I couldn't see a world where you could run it as a profitable business. But they have several food delivery businesses that they can combine in different ways in order to extract value and gain scale in that space. And that's not even to start on the payments businesses that I think still has a lot of scope. So I like both of those stocks. I'd probably prefer Naspers because it's trading at a deeper discount. There's a lot of work being done to narrow the discount as well with share buybacks and the like. So yeah, that's the long and the short of it.
We had a question come through on Monday, and Chantal has promised to answer this question for us today. It goes, T-Mobile. The question reads, I came across something with T-Mobile starting to sell Starlink subscriptions soon, and I was wondering if this would be good for them as CapEx has historically been very big market, making them not so FCF positive. Now, with them going to sell Starlink subscriptions, they won't be spending much capital as Starlink is already up and in space, making this hopefully quite a profitable idea for them. Possibly, they're currently testing out the Starlink services. Chantal?
Yeah, so it's actually a very interesting story. T-Mobile is it's a mobile telecoms operator, right? Like Vodacom or MTN. A big footprint in the US, their main competitors being AT&T and Verizon. So they obviously went into it was voice, then it went into data services, and now they are looking for a next step in growth. So focusing a lot on fiber, very similar to what Vodacom is doing.
Yes.
And space in enabled text messaging services at a very, very low cost or free to their subscribers. So just for context, in the US, consumers are still texting each other via SMS. They don't really use messaging platforms like WhatsApp or WeChat like we do in South Africa. So they get charged for every text that they effectively send, or they get these bundles where it's extremely cheap. But for T-Mobile users, with the Starlink tie-up, it will be free, and they will be they're planning to extend it to Verizon and AT&T customers as well at a $15 a month flat fee. And that has resulted in them looking a lot more attractive from a competitive perspective as well, because once you onboard them for Starlink texting, they might just decide to migrate their subscription to T-Mobile. The share price has responded to this quite strongly, though. So the company is trading at a premium to its peers, quite a sizable premium to its peers. And if you strip out the COVID-19 period, where it was trading at extremely expensive levels, along with anything else that was enabling communication over a screen, then it actually looks quite expensively valued. So you're buying into one part of the business, but it ends up being a telecoms provider ultimately, and it shouldn't be trading at such elevated levels longer term.
All right. Roy, let's stick in the telco space. A question here saying, looking at the year-to-date performance for JSE telcos, they appear to be hit. What would you say would be the catalyst for a turnaround in the performance of these local telcos counters?
I'd actually say they've done relatively well. I mean, as of the last month, we're probably among the top performers, specifically Telkom and MTN. Vodacom also caught up, especially after their capital markets day. And I think what's happening here is, to invest in a telco, you basically are looking for service revenue growth that is above inflation, and them earning a return on equity that is higher than their cost of capital and the ability to pay dividends. So MTN has had the problem around Nigeria. In the Nigeria results issued today, we saw most likely that problem is behind them and they'll be able to resume growth in that market. Telkom's been brilliant in that they've never had voice. They deployed a data-only network, and they've got the cheapest data out there, and they're growing service revenue at like 12-13%. Remember, inflation here is maybe what, 3-4% on average. So they're generating significant value and widening margins. Whereas Vodacom, on the other hand, remember they invested in Egypt, and what hurt them was there was a huge devaluation in Egypt, and right now they're cycling that base. So when you look forward from here on, in all likelihood, you'll see some solid earnings growth. In Egypt, they're growing service revenue in the 30s and the 40s. I mean, it's aggressive growth, while Safaricom is not even anywhere near being mature, so it's also growing. So I think over the next 12 to 24 months, you're going to see these companies come back into focus. More capital efficient, higher margins, strong cash generation, and a return to dividend paying. I think in the next 12 months, both MTN and Telkom will be able to grow their dividends. Vodacom's always been a prolific dividend payer. Maybe they'll not pay as big as they paid historically, but I think they will continue having a solid dividend yield. So I think these ones offer value, all three of them.
Chantal, I see you nodding there. Do you share the same sentiments as Roy, particularly with MTN, who have also said that, you know, the hike in tariffs in Nigeria would also work in its favor moving forward?
Yeah, absolutely. I think the Nigeria story is going to be the real kicker for MTN over the next year. So it's not only the tariff hike that is going to help them, but it was the first tariff hike in something like 14 years. So a massive tailwind for MTN in Nigeria. And the second thing is they actually did a lot of work on their cost base in Nigeria. They reworked their tower leasing contracts that were basically denominated in US dollars and converted that to be more aligned with what the Naira is doing. So it just de-risks their cost base, because historically, if the Naira devalued heavily, they were still liable for these lease agreements that they had, with these lease payments that they had to make in US dollars. And that resulted in huge losses in the Nigerian business. So I think that has been fixed. I'm still quite excited by both MTN and Vodacom's fintech businesses that can eventually stand on their own as well. I hope the fiber story continues to roll out strongly for Vodacom. And then also in Telkom, I've been so impressed more recently with what's been happening in Telkom. They've started right-sizing their cost base. They put a lot of effort into that. The legacy business, which is the fixed line business, has declined heavily, but it's now a much smaller part of that business. So the declines can be absorbed easily by the very solid growth that we're seeing in mobile. They're selling non-core properties, SwiftNet's being sold as well. So yeah, I mean, I'm also quite positive on the sector for the next 12 months.
Let's move over to a sector that has pretty much everyone excited, the AI industry, in particular chips. The question reads, is there a reason not to buy TSMC now? Roy, let's get your take on that.
It's not one that I follow particularly
Okay.
closely, but the perspective here is probably around where tariffs may go and whether they may have a problem actually being able to deploy their chips. I think what's happening with Trump, although we promise not to speak too much about him, is that they're trying to put these obstacles that China doesn't get access to chips, and that's where the problem is. I mean, when you look at Nvidia on the other side,
Yeah.
in the US, when they released their results, I mean, they were gross margins in the 70s. And they've just continued to grow. So their development process seems to be unhindered. Their distribution seems to also just be growing, and demand for their product remains significant. I mean, all the big players are still applying capex, which is basically paying them for development and for new chips. So I think broadly the chip cycle isn't yet over. AI is going to continue driving demand for increasingly more efficient chips, and all the manufacturers who are able to match this demand should continue to benefit over the medium term. I mean, with the lowering in entry prices for AI development, that's going to broaden the market for people who want these machines and who will develop all of these applications such as DeepSeek and the like. So no, I think this is their time in the sun.
Now, just sticking with that for a bit, besides the tariff stumbling block, there's also been reports suggesting that TSMC would be one of the companies that would buy a unit of Intel if it does split. What have you made of that move or potential move, Chantal?
Yeah, so it's quite interesting. So just to clarify the way in the cycle TSMC fits in. So it's a fab. So it's the company that manufactures the chips that are designed and developed by NVIDIA and AMD and the like, right? So they're a manufacturer essentially. Demand for chips are exceptionally high, and not only leading edge chips, but other chips as well. And in terms of the leading edge chips that are in massive demand for these AI developments, TSMC is by far the market leader in being able to actually manufacture these chips. They've invested a lot of money in capacity building over the last few years, opening new fabs globally, including in Arizona in the US. If Intel, which is a US-based producer, is going to sell its chip manufacturing business, TSMC, I think, will want to grab that opportunity because it's exceptionally expensive to set up a fab.
Yeah.
Whether or not the price is going to be right, I think, is the biggest question mark here. Not too worried about TSMC with tariffs at this point because it's Taiwan-based, and well, Mr. Trump's policies are very interesting, but he does not like China, and Taiwan does not like China either. So, yeah, I think that that risk for them is quite low. And as Roy mentioned as well, I mean, we're still in that upward cycle from a chip perspective. Just be careful. Chip manufacturers as well as chip designers are highly cyclical. So while we do have the structural support right now, once that normalizes, you'll start seeing a normal inventory cycle. So there could be volatility ahead, but I think for now, I'm still very comfortable investing in TSMC.
All right, before I let you go, let's get into your stock picks. Chantal, I'll start with you.
Yeah, so I mean, I have a European stock pick today. A lot has been said about the rotation out of the US into European stocks, and that's driven up valuations. But there are areas of that market where really you haven't seen a lot of movement. And a lot of it is in these high quality consumer companies. So my pick today is Birkenstock. I'm wearing my Birkies as we speak. The company listed about 2 years ago. It came out of private equity, so very highly indebted. And they have done so much in terms of cleaning up that balance sheet and with that set to continue. Manchester said they want zero debt. And I think that the prospect of much higher returns on invested capital and returns of equity going forward is quite positive. Free cash flow generation is quite solid, and the footprint is still quite limited. They've seen very good traction in the US for their product, but the store footprint is still exceptionally low. So I think that they'll continue to expand the store footprint, continue to grow the brand, and it's trading at a very undemanding forward PE, and quite a bit below kind of the consensus fair value currently.
All right, Birkenstock for Chantal. What are you hanging your hat on, Roy?
As always, I'll stick local because I think there's still lots of value to be found here.
Okay.
So my pick is Rhodes Foods, so RFG Holdings. This is it's a small cap, but in the real world of packaged food manufacturing, they are a proper giant. They produce pies, juices, the Bull brand of canned meat, and they rank #1 in most categories that they produce. This is a business that generates about an 18% ROE. It has no debt, strong cash generation, and it's grown earnings over the past 5 years at about 17-18%. It's currently trading on like a 7 times multiple. It's as cheap as it gets. This is one of those little compounders that over time will continue to grow earnings and return cash to shareholders in quite a profitable way.
And well, that's where we'll have to leave it for today's show. Thanks to our guests, Chantal Marx from FNB Wealth and Investments and Roy Mutooni from Sanlam Investments. Remember that Stockwatch pre-records on a Monday and Wednesday at 1 p.m. and is live at 6:30 p.m. on a Tuesday and Thursday, while Stockwatch this week is live at 12:30 on Fridays. Keep that in mind and keep your questions coming. For now, that's all from Stockwatch this week, but do stay tuned for lots more coming up right here on Business Day TV.